In our previous session, we discussed Introduction to Financial Management. Today, we are going to explore a new topic, none other than goals of financial management. Imagine you are starting a very new business and have very limited resources to manage. You need to plan budgets, allocate funds, manage risks, and ensure profits while maintaining smooth operations. In this scenario, how would you prioritize and handle key financial functions like investment decisions, financing, and cash flow management to ensure the long-term success of your business?
At the end of the session, you'll be able to identify the key functions of finance: investment decision, financing decision, liquidity decision, and dividend decision. Analyze the risk-return trade-off in financial decisions for wealth maximization. Recognize the role of prudent financial decisions in creating shareholder value.
The finance function is a critical aspect of any organization, focusing on the management of financial resources to achieve business objectives. It involves planning, acquiring, managing, and allocating funds to ensure operational efficiency, profitability, and long-term sustainability. Key activities include budgeting, investment decisions, risk management, and financial reporting. The finance function supports strategic decision making by providing insights into cost management, funding opportunities, and financial health. It plays a vital role in balancing profitability with liquidity and safeguarding shareholder interest. Ultimately, the finance function ensures optimal resource utilization and drives the organization's growth and competitiveness in dynamic business environment. The functions of finance encompass four key areas critical for business success. Number one, investment decisions, wherein capital budgeting, it means evaluating and selecting projects or assets to invest in for long-term growth. Second is financing decisions, also termed as capital structure, determining the optimal mix of debt and equity to fund operations and investments. Third, liquidity decisions, working capital, ensuring sufficient cash flow to meet short-term obligations and operational needs. Fourth, dividend decisions, that is payout, deciding how profits should be distributed to shareholders or reinvested for growth. These functions collectively ensure financial stability, profitability, and strategic alignment with the business goals. Investment decisions, also known as capital budgeting, involve deciding how to allocate resources to long-term assets or projects to maximize returns and ensure business growth. These decisions assess the profitability and risk of investments, guiding organizations in selecting the most beneficial opportunities. For example, companies evaluate whether to invest in new machinery, expand operations, or launch a product. Investment decisions are critical as they affect the business' future performance and competitive positioning. Key factors considered include cost, expected cash flows, and market conditions. Properly executed, they help achieve strategic goals and enhance value creation for the stakeholders. Investment alternatives. They are typically evaluated by analyzing the cash flows generated by a business project. Cash flow analysis helps business assess the profitability and feasibility of potential investments by considering the expected inflows and outflows over time. This evaluation focuses on metrics like net present value, internal rate of return, and payback period to determine whether an investment will generate sufficient returns. By prioritizing cash flow, companies make informed decisions that optimize resource allocation and minimize financial risk. Financial decisions focus on determining the sources of funds a business uses to raise capital. These sources are broadly classified into equity, which is ownership funding, and debt, which is borrowed funds. The choice of financing depends on factors like the cost of funds, with equity generally being more expensive and the risk involved, as debt increases financial leverage. Businesses aim to achieve an optimal capital structure balancing equity and debt to minimize cost, while maintaining financial stability and supporting long-term growth. These decisions play a critical role in sustaining operations and funding future investments. When an organization borrows funds, it incurs interest as the cost of borrowing, alongside associated risks. Borrowing through debt entails lower cost but increases financial obligations. Conversely, equity funding involves higher expectations from shareholders. As they are the business owners who bear all the risks, equity shareholders demand higher returns due to their greater exposure to business risks. Each funding source carries unique risks and costs, influencing financial decisions and the overall capital structure of the organization. Debt financing involves borrowing funds, typically at a lower cost compared to equity. It is riskier due to repayment obligations and usually has a redemption date. Debt increases financial leverage but also allows businesses to retain ownership. Equity financing represents permanent capital where the risk is borne entirely by the owners, while it is costlier than debt due to higher returns expected by shareholders. It does not impose repayment obligations. Both financing methods have distinct advantages and risks, and an optimal balance between debt and equity ensures financial stability and growth. Liquidity decisions focuses on managing short-term assets such as inventory, receivables, and cash, which are essential for the day-to-day operations of a firm. These assets collectively form the working capital, ensuring smooth business activities and financial stability. The primary challenge in liquidity decisions is balancing the trade-off between profitability and liquidity. While maintaining high liquidity ensures operational continuity, it may reduce profitability due to idle cash or underutilized resources. Effective liquidity management is crucial for sustaining operations, meeting short-term obligations, and maximizing return, ensuring that the business remains financially sound and operationally efficient. Liquidity decisions focus on balancing adequate liquidity levels and maximizing returns on investment. Effective working capital management involves optimizing, not maximizing or minimizing, resources to ensure smooth operations. By maintaining the optimal level of working capital, organizations can improve operational efficiency, enhance liquidity, and reduce financing cost. This balance supports timely payment obligations and cash flow management while maximizing profitability and ensuring financial stability. Proper liquidity management contributes significantly to overall organizational success, fostering resilience and long-term growth. Working capital management involves optimizing short-term assets and liabilities to ensure a company's operational efficiency and financial health. Its key elements include management of inventory, wherein ensuring optimal stock levels to prevent overstocking or shortages. Management of receivables, wherein monitoring credit policies and ensuring timely collections to maintain cash flow. Management of cash, maintaining sufficient cash reserves for daily operations while avoiding idle funds. Management of spontaneous financing policies, efficiently handling trade credit and accrued expenses to support liquidity. These elements collectively enhance liquidity, reduce financing costs,
and contribute to overall profitability and stability.
Dividends represent the portion of a company's profits distributed to shareholders as a reward for their investment. Unlike interest on debt, paying dividends is not mandatory, allowing companies flexibility in their financial planning. Retained earnings, the portion of the profits not distributed as dividends, serve as an internal source of financing for future growth and investments. This balance between dividend payments and retained earnings ensures companies maintain adequate resources to meet operational needs while rewarding shareholders, fostering both financial stability and investor confidence. Dividend decisions involved determining the portion of profits to be distributed to shareholders and the amount to retain for the business growth. These decisions depend on three key factors: availability of the funds, wherein adequate cash flow and profit levels are necessary to support dividend payments; preference of shareholders, companies consider shareholders' expectations such as consistent dividends to maintain trust and loyalty; Future fund requirements, wherein retaining earnings for future investments, debt repayment, or business expansion often takes precedence over dividends payouts. Balancing these factors ensures financial stability, supports growth objectives, and satisfies shareholder expectations effectively. The risk return trade off underpins financial decisions, balancing risks and potential return to maximize the wealth of the business owners. This involves investment decisions, also termed as capital budgeting, wherein evaluating high risk investments with potential high returns. Second is financing decisions, also termed as capital structure, choosing between equity and debt based on cost and risk. Third is liquidity decisions, also termed as working capital, wherein balancing liquidity to meet obligations while ensuring profitability. Fourth is dividend decision, also termed as payout, allocating profits between shareholders' dividends and reinvestments for the growth. So by carefully managing these decisions, businesses optimize resource allocation,
achieve sustainable growth, and maximize shareholder value.
In this topic, we have learned that the functions of finance are investment decisions, financing decision, liquidity decision, and dividend decision. We have also learned the risk-return trade-off underpins financial decisions, balancing risks and potential returns to maximize the wealth of the business owners. We have also learned prudent financial decisions lead to shareholder value creation. That's all for today. Thank you and happy learning.